Welcome, everyone. Thank you for joining us. My name is Ed Sullivan. I will start momentarily. I'm still waiting for a few people. I see that people are coming in and some people are looks like they're getting knocked offline a little bit. So I'll give it another minute or so and then we'll jump right in. Thank you. Good afternoon or good morning, everyone. Thank you for joining today. My name is Ed Sullivan. I am the founder and CEO of Trust Exchange. And I think we're going to get started. We have a good group here, and it seems like everybody is stabilized, at least the people I saw that were falling offline. But I will just jump right in. This is being recorded, and if you want to watch it later, we will make it available on our website. Also, if you have any questions, feel free to put them in to the question box, which should be up on your screen. And then we have like a little poll around some of what would your reaction be to the new third-party risk guidelines that have come out from the various regulators in the banking space. Our software is used in multiple industries, but a lot of banks, credit unions use us. So we find it interesting that the guidance is changing. And my read on it is that the guidance is making it more difficult and more expensive to manage this critical area of operations. However, I think we have a pretty good solution for it, and we'll talk about it at the end. But I will go into a little more detail as we get through the presentation. So this is the agenda I want to go through. We should probably not take a full hour. It'll probably be about 40 minutes, and then we'll leave 10 minutes for questions if there are any questions. But basically, Trust Exchange is a B2B marketplace. So we enable our clients to create custom networks. We'll talk about that in a minute, that enable them to collaborate more effectively, invite key collaborators, vendors, internal employees, staff, third-party advisors, etc., to collaborate via a network similar to like a Facebook or something like that, where they can more effectively exchange and see information in real time, what's going on relative to their third parties. I'll talk about why this is a deceivingly tough problem to manage, expensive, difficult, hard to scale. What we see is a lot of people will try to brute force this versus using automation because it is hard to automate. I'll review the key problems that you're probably running up against in this space. I'll talk about the new world of software, where kind of like software is moving from 20 years ago you had to buy the software, install it yourself, to being in the cloud, to now being collaborative tools that some of you are familiar with as consumers of software, but then also beginning to come into the enterprise as well. We'll talk about some of the solutions, how you can build a virtuous cycle where the more the software is used, the more people that you bring into the network, or the more entities that you bring into the network, the faster the data, the better the data, more people, more valuable, and it just ends up being a virtuous cycle for the organization. We'll talk about a bank use case. We'll talk about an ESG use case, and we'll do questions and answers, and then discussions around the new guidance that came out just last week. Okay, so this is really a deceivingly complex problem. The main reason that it is hard to scale and hard to really get on top of as an organization is that it's an exponential problem. So this picture here shows a 5x5 clients and vendors, banks and vendors, pharma and vendors, local governments and their vendors. And what we see in industry by industry is that the vendor overlap is pretty high. In banking, the vendor overlap is 60 or 70%. And this depicts kind of 5x5, 3 pieces of information traveling each way. It assumes that all of the information is successful every time. Every time a bank asks for the information, they receive it right away. There's no spam, there's no vacations, there's no person left the company, or that the data has not been updated. It assumes everything is perfect. And you can see that the number of transactions and interactions that occur get exponential pretty fast. The other thing is that the software model is broken and doesn't really support this. And we've seen through our experience that the software that is used can be people, spreadsheets, email, up to very expensive platforms that might cost $50,000 or $100,000 a year to operate, and even they don't really solve the problem that well. And then the third thing that makes this very complex is that the change is accelerating. Since in banking, since Dodd-Frank, there's been rules and regulations and guidelines and enforcement actions that are confusing, that changing, best practices change, rules change, and the systems that are out there today just don't solve the problem. One kind of ridiculous story I tell often is, imagine we live in a world where we all have to buy our own version of Facebook. We go to Staples, buy our version of Facebook, bring it home, install Facebook on our laptops, add profiles for all of our friends, nag all of our friends for their pictures, their updates, etc. And obviously that's ridiculous because that's not how it works. Facebook is a platform. It enables everyone to come in and use the platform. You don't add your friend's profile, you add friends into your network. So what we do is we're similar to that at Trust Exchange, and it points out that it's really hard to scale this problem with people and spreadsheets. So if you end up, just like imagine your high school class, you might have 100 friends, or a family, or you might have 50 relatives that you're trying to communicate with, send pictures, etc. Imagine this is banks and vendors, or pharma, medical device companies and their vendors. It's really hard to get on top of getting this data, sharing the data, approving the data, reading the reports, and understanding what's going on. It's very cumbersome. People in spreadsheets and even some modern software as it is today just doesn't scale. So the good news is it is a new world. We're moving into the collaborative economy. In the enterprise, you've probably seen things such as Slack, Teams, that enable collaboration inside of an organization or in between organizations. But the consumers have really kind of led the curve in terms of adoption of this, where Uber, we've probably all used Uber or Airbnb or Waze. They're all examples of network effects applied to platforms where Airbnb doesn't own any hotel rooms. They create marketplaces to enable people that want to find a place to stay in different geographies. Uber is the same thing. It's not just a taxi. It's a way that they can go in and create local marketplaces between drivers and riders and match the data up. And that's what we are at Trust Exchange. We are a way to create a marketplace among you and your vendors, where the vendors can come in, they can collaborate with you based on rules that you create, and enable the broadcast of that information rapidly through the network. If you're on the receiving side of that problem, this problem here, imagine you're a vendor, and if you're a vendor in banking, it's likely that if you have one bank as your customer, you may have 10, 20, 50, 100, or even 1,000 banks as your customer. And in those cases, imagine having to get all of this stuff out via email, PDFs, delivering that stuff. And if you look at it as a social network where you can just broadcast this stuff out, it makes it a lot easier to solve the problem. Now imagine you're monitor your bank and you're monitoring a vendor that's using another fintech to provide services for you, and you're required to monitor that third party of a third party. It makes this diagram even more hard to understand and more complex to monitor. All of these things that we've experienced, Airbnb, Uber, Waze, take all these transactions and interactions and common denominator them out via network effects. And this leads to being 10 times more flexible, 10 times faster in terms of getting the information to people quickly, getting information to use and collaborate on more rapidly, and makes it 10 times more cheaper. It's cost effective. It puts you in a position where you're more prepared for regulatory scrutiny and gets the information so that it's visible and transparent. With us, it's really easy to do. There's kind of like 3 steps to doing this. Step number 1 is create your own network. So in Trust Exchange, you can go in, build a collaboration network, create your own policies. For example, if it's an IT vendor, I want to see their SOC report and your business continuity report and this and that. And you might have that layered on to other rules that you can create and customize and configure. And it could be logic, it could be ands and ors. And then kind of riding on top of all this is being able to manage the frequency. So one of the things that also makes this difficult is that certifications expire, audits expire, your requirements may change. So this is all information in motion that doesn't really move very well inside of software that you're running inside of your environment, whether or not it's in your own data center or in a cloud environment. And a lot of people are talking about how AI is going to change the shape of it, but my contention is that AI doesn't help this problem. It may help with what are good rules to have. It may help with what are good policies to have, but future data in motion isn't something that AI can do. The best AI can do is kind of look at patterns, look at existing things, and say, oh, this is different from that, or if you compare these 2 things, here are the best of these 2 things, and do that. It doesn't really, it can't tell you what the temperature is going to be of something tomorrow, or it can't tell you, predict that a network is going to have a technical failure or a mechanical failure in 48 hours. It just cannot do those things. So if you create the network, connect your collaborators. Curators are in our parlance are people that add events, and then validators are people that validate events. So an example might be a SOC report. Your vendor, you may have a rule that says, hey, vendor, give me your SOC report. In the classic way of doing it, they would email it to you when it's up, or you would nag them for it and they would email it to you when they're nagged. With us, you can create it, put it on the profile. You can create a rule that in order for it to be green on your dashboard in your network, not only do they have to deliver the SOC report, but they have to deliver the SOC report. It has to be current. And one of your team members that is a validator in your network has to go in and approve it, give it a thumbs up and say, this is green. And then the validators can go in and they can get their own dashboard and see what are the things I need to work on. I got to go in and look at this demo. I got to go in and look at these service level reports. Here are the things I need to review to make sure that this is a vendor in good standing. And then the next step is kind of activating it, going in and managing by exception, inviting the network participants in, manage by exception, looking at your reports, and it makes it a problem, 100% problem to like a 10% or less problem. We have use cases in banking, credit unions, and especially community banks where they don't have the staff to do a lot of these things, where they can rely on third parties to come into the software without having to buy a full license, come in, look at a report, and verify that this is good, or this is less than adequate, and I need these additional checkpoints to happen in order to approve this. So once the network is activated and you've created the rules and you have your collaborators in, some magic happens, and we kind of call this the virtuous cycle. We stole this from Uber's original pitch deck to their investors, where they felt like they could go into a town. Let's use San Francisco as an example, where they started. They would hire drivers, buy cars, and give away rides, and it became a kind of a compounding snowball going down the hill, where they, after a period of time when they had more drivers, more riders, where they didn't have to hire drivers anymore, they didn't have to buy cars, that, the more riders there were, the faster, the shorter the wait times for both the riders and drivers. And it just cycled into something that was very valuable. The more people that joined, the better information that came. The more drivers that were there, the shorter the wait time. The shorter the wait time, the more riders that came in. and they were able to do things faster and grow bigger markets and add more value to the organization in terms of being faster and being more cost effective. And we see the same thing when we're doing vendor management. We take this problem that is multi-sided, many to many, and kind of common denominator all the sides of the equation out and make it so that this virtuous cycle enables the banks to see their information faster. It enables the vendors to see what do they need for various banks. So a vendor could be in multiple networks. They could be in Bank One's network and Bank Two's network. They can create sharing permissions. I want Bank One to see this, Bank Two to see that. They may be providing different functions to different financial institutions. They could be providing call center services. They could be providing software services to another bank. And the rules that they have to comply with are different. You may be a single bank and have the same vendor doing 2 or 3 various functions for you, and then being able to monitor them appropriately based on the function and monitor them in a couple of different ways based on what their risk is for that function to your organization. So I'm going to pause there. Thank you for the extra people. It was a thank you. Good afternoon, and thank you for joining us. If you have any questions, feel free to pop them in as we go, and I will try to answer them as I go along. But the basic thing is that we are a network effect solution where we enable our clients, banks, credit unions, pharma, local governments, to form their own social networks to solve these critical problems of third-party risk, vendor management, public safety, etc., and making it very simple and cost-effective to do this. We're a lot less expensive than existing systems. You don't have to install anything. We don't charge per seat. We enable you to come in, share best practices between banks, share best practices between vendors. A vendor may have a best practice for you based on the service they're providing, and they can give you a rule in our system that says, hey, here's how you should be monitoring us. You should be looking at these 5 things, not these 2 things over here. And you should be looking at these things weekly and monthly versus annually. And in the new guidance, that's really the thing that I think is going to make this more complex and make it harder for other providers to solve, is that frequency aspect. Being able to look at it as a life cycle, and I want to look at things weekly, monthly, maybe daily, depending on the risk that third party presents to you, and getting transparency and visibility throughout your organization, but also enabling the vendors to see what are they doing wrong relative to your policies that they need to fix, so that they can help you get into compliance and have a better stance relative to your risk and third-party compliance management. The other thing that we have in here that we're working on is adding things like blockchain and Web3. I know those are scary topics for a lot of people now, but if you just separate in your mind the speculation on crypto from the value of Web3 and blockchains, and being able to store these validation events into an indelible blockchain that you can have forever, and it is auditable, it is immutable, and no matter what anyone tells you, somebody can change software. There's always some person in the back that has enough permissions where they can go in and make a change to the software. And with blockchain, that can't happen. So the value of being able to make this digitally transformed, but also making it digitally transformed and immutable, is very valuable, especially in highly regulated industries such as banking and pharma. So I'll say again, there should be a way for you to pop questions in on the web app if you're following along here. So some of the use cases. So in banking, and we service a couple of large banks. We're large on the community side, right? So $1 billion plus, 1 to 3 billion, down to micro banks and credit unions. And there's a use case where we have a custom network that we created for a bank where they had like 200 or 300 vendors. They were getting bad marks from a couple of different regulators, the state regulators and the federal regulators, and they were really getting hammered. They were being threatened with sanctions and kind of like, the worst case scenario for a bank relative to this. So what we were able to do is take them from getting an F in the class to pretty quickly getting an A in the class. So we have it's over 700 vendors that are being monitored in our system now. And if you, by the way, if you join our network, it's kind of like joining Facebook, where if you and I become friends on Facebook today, you can go through and see my history to the day I joined Facebook, not just from today forward. If you were buying and purchasing your own software, you could only look at the vendor's history, limited by when you input that data and how much data your team has put in and analyzed. You couldn't look at public information. You couldn't look at third-party analyst reports. You'd be very limited as to what you could do. Some other cool things is collaborating with your teammates. We enabled it so, like, there was a couple of banks that were in our network, and the CTO of, let's say, bank number one shared best practices with some of the other banks. So one of the good things about a network is that you can create custom groups and subgroups. So this CTO, she created a subgroup among her peers of chief risk officers and CTOs and CIOs in the other banks, and said, hey, here's how I'm managing this vendor type. Here's how I'm managing this other vendor type. And they were able to share best practices. And in this particular case of this bank that was struggling, we were able to match them with a partner of ours that had gone through the scrutiny of several regulators and gotten good marks. So they were able to go from having no transparency, not good practices, to getting an A in the class and just being in a better stance. So they had better vendor compliance. They reduced their costs. So they got all this and reduced their costs. They had people all through. The CEO himself was running around reading SOC reports, shuffling, making copies, creating folders. They were moving paper around versus moving around bits and bytes. So they were able to reduce the cost by 60%, and they were able to recapture the capacity of key individuals inside the organization that were doing this repetitive compliance work that we were able to automate for them. They went from getting an F to getting an A+. We're also, one of the other cool things about these network effect solutions is that they usually a parallel or tangential solution that can be solved as well. So in this particular case, we helped them with their PPP loan forgiveness process, which is kind of like in the past now, but it was an emergent problem for them that we were able to turn on for them pretty quickly. They were able to also manage some of their loan portfolios, and then they were in a state where cannabis was legal, and they were looking for ways that they could help bank and make some of these cannabis-related businesses bankable. And they were able to do that in the same platform where they were managing vendors, et cetera. I noticed a couple people joined. So we're talking about the use cases of the platform and how it works. Feel free to enter any questions into the app. It should push them out to me. The second use case is ESG. So while I'm treating it separate and distinct for banks, a lot of banks are coming to us now asking us, how can they manage ESG, not just for themselves and improve their standing relative to ESG compliance, but also some of their key customers. The system that we developed this with a partner called EcoCertify, and they used our system. They built a series of processes, procedures, best practices to help their clients get onto a journey of a standstill, basically zero, to being able to show their constituents, their board members, their investors, some mutual funds that were investors in them, take confidence in that they were moving forward in this process and being able to show with real transparency what they were doing. So they were able to do it for a couple of Fortune 500 companies, embedded the standards, automated the compliance, and they were doing supply chain transparency, supplier diversity, some energy applications as well, which they were able to build into our platform. And again, it was reduced cost, increased speed, better flexibility, etc. I'll pause there for a minute to see if there's any questions. We also talked a little bit about the new guidance for banks that came out. There's a poll questionnaire. Love to see if you guys have any answers on this. Like, is everyone happy? Is everyone more confused? Is everyone having nightmares about what it's going to cost? It's just another layer of activity that's going to be hard to manage on top of what you're already doing. So it would be great to kind of see what the responses are there. Any questions on this? I'm going to go back a couple of slides and just talk about activating these networks and how an implementation might work. And by the way, in the banking space, depending on the size of the bank and the number of vendors that are monitored, we can get this up and running in 30 days ish. So an example was a large bank that had purchased a $50,000 software package that they were not able to get up and running for about 13 months. We were in their RFP process. They liked our solution. They felt like it was too good to be true. They chose someone else. That system did not get implemented. They came to us and we were able to get them up and implemented in about 60 days. And the key steps there are create your network. So inside of Trust Exchange, you can create your own custom social network that's closed and controlled by you, where you can create what events do you want to see? I need a SOC report. I need proof of insurance. I need audits. I need internal reviews, and create policies around those events. And you can create ands and ors. You can create frequencies. I want this to happen weekly. I need this to happen monthly, and be able to really kind of, take the science of it and put it into an art where you can do things like manage multiple vendors under different criteria, or manage the same vendor under different criteria based on what function they provide, if they provide multiple functions to your financial institution. The next step is connecting the collaborators. So in those original drawings where I just show, hey, here's a vendor and here's a bank, it's not always that way. If one of my requirements is I need a SOC report from you, or I need you to prove to me that you have cyber liability coverage of at least X, then in both of those cases, the vendor is not creating that document. Those documents are being created by the insurance company or by a third-party auditor. What we do is we encourage you to bring those third parties as collaborators into the network, where you can go in and say, okay, vendor, here's your insurance for cyber liability. I need you to have $10 million of cyber liability, and I need you to verify that once a month or once a quarter, or I need your carrier to verify that once a month or once a quarter. Somebody's asking me to rewind a few slides. I think, not sure where they mean, but this is the basic overview. Here is the original slide where I was talking about why this is such a tough problem. It's an exponential problem. It's hard to solve with software. Existing software is a broken model where you have to go buy your own software. You can't share software between banks. Vendors can't share software. If I'm a vendor and each of my banks is asking me for the information, I have to send it to them independently. I can't just post it onto my profile page, which you can do in Trust Exchange or similar to like a Facebook, and have it broadcast to everybody that's following me. And then the other component that makes this difficult is that as time moves on, change is accelerating and the requirements could be accelerating. So you may have a vendor that's a low risk vendor for you this year, but next year you buying more services from them. So the services are even more onerous. So, or the requirements to manage the risk of that service are even more onerous. So I might have to look at things, whereas I was looking at things quarterly and annually, I may now need to look at things weekly and monthly, depending on the risks that they present to me. So the traditional software just doesn't scale with this problem. So solving the problem with us, implementation, create your network, connect the collaborators, and then activate your network. So by activate the network, it usually takes about 30 to 45 days to start getting data that you feel comfortable with. Well, that actually depends on how many of the vendors are already in your network. There's always kind of like local providers for things like janitorial services, maybe staffing, where there are local providers that we may not have in our database or that aren't being monitored by other financial institutions that you would need to add independently. And what happens is the dashboard is real time, and the reporting system that we have gives you a way to look at things retrospectively. So, okay, hey, I got to give a report to my board on the last quarter. Here's my vendor space. Here are my policies. And here's how many violations we had of the policies over time. We had 3 violations with this vendor, 2 violations with that vendor, which is also an important thing for the regulators to see, so that you can see that, hey, this, do I have a 3 strikes and they're out policy, or a 3 strikes and I put them in a penalty box and I monitor them at a higher frequency? What are the different things that we can do? Once this is all activated, it creates what we call this virtuous cycle, where we are adding more events, adding more vendors, more third parties, more data, faster, more clarity. And the more people that join the network, the more entities that participate, the better the data is. It's better, faster, cheaper. And we can do it in a way where we can take care of NDAs, we can manage privacy, we can create private subnetworks. I was giving the example earlier where chief risk officers of multiple banks can come in, create a collaboration subnetwork where they're talking about, hey, here's this vendor that just had a breach. How are you managing the breach? How are you notifying your customers? How are you monitoring them going forward? These are all things that we're managing here. So let's see, how am I doing on timing? So we got about 20 minutes left here. And going through the questions, let's see. I think I need to stop the poll in order for you guys to see the rest of the slides here. Well, we're at the question stage. I can't figure out how to share. So I apologize for that. But basically, I'm going to go through and start answering the questions. So some of the questions we're getting are, what is the pricing? Well, so our business model is unlike a lot of the other systems that are out there, where they're billed by the number of seats, or they're billed by the number of instances of the software, or how much data you have. We basically charge a baseline fee, and then bill based on how many things you are monitoring. So it's a little bit different model that we have that is a lot more cost effective. Another example, another question is time to implement. We were talking about that a little bit earlier. In some cases, the implementation time may take 30 or 60 days, which is a lot better than some of our peers in this industry. In some cases, where we have a network of banks or a network of credit unions or a network of providers that are coming to us together, it might take us 30 or 45 days to get the first 2 or 3 on. But once we get to like 4, 5, and 6 and beyond, it can take as little as a week to get our clients up and running with this. So just to summarize, we think it's better to use networks, not software. So networks are the future. Software is changing. Being able to control shared data is going to be very powerful. When you just think of how rapidly Uber and Facebook and Waze have all grown and able to provide better information faster. My email address is edsull, EDSULL, @trustexchange.com. We'll be reaching out to you after the webinar, forwarding you information. If you want to see a demo, happy to jump on a call with you and walk you through, talk about what your specific requirements are and how we can help. If there are any more questions, pop them in the last couple of minutes here, and I'll try to get to an answer. Yeah, so it's pricing, implementation time, and building out the networks. So one of the things that we have is a network of providers. So let's say you're a small community bank and you don't have a large network of employees that are qualified to do like penetration test results or analyze SOC reports. We have a network of third-party providers that, for a fee, will do this inside of our network and know our system. And some of them are ex-bank examiners or NCUA examiners, and they can come in and solve this problem on our platform for you. Well, are there any more questions? It's interesting looking at the poll data. I don't know if I'm still sharing the poll data, but it looks like about a third are excited that the new guidance is adding clarity. I read the new guidance. I would say yes, some things are clear. There is some consolidated information. It's a little bit confusing on or they talk about manage the life cycle in a risk appropriate way. Do I look at things monthly, weekly, quarterly, annually? There are some best practices out there that we can share with you that are kind of regulator tested. They've been through several layers of examinations. Another third are saying that it'll be very expensive, and I agree there. The expense really comes down to the frequency part, and not just doing a initial due diligence and then an annual check. It's doing initial due diligence and then continuing to verify and monitor. So the monitoring aspect through the life cycle is what could make this expensive, especially if you're trying to manage it via manual processes. The balance, about 23% are like more confused, and then 15% are like, no big deal. So I guess it depends where you are in your life cycle of building out a platform. Are you looking at 100% of your vendors? Are you looking at a small subset of only your high risk vendors? That's another part of it, is that they're moving towards 100% monitoring. So your lowest risk vendor to your highest risk vendor all need to be monitored appropriately, which, if not done correctly, could drive the expense way up, especially if you treat all the vendors the same. If they're all being treated as high risk vendors, it could get very, very expensive. Well, thank you all. I will give you time back. My email is edsull, EDSULL, @trustexchange.com. You can go to trustexchange.com and review our different use cases and see what we're doing out there in the industry. And then also, if you'd like to schedule a demo, we'll reach out to you after the webinar and see if there's you would like to set up a meeting and see our platform in action. So with that, I'm going to end the webinar. Thank you very much. Have a great rest of your day.